Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who've cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Welcome back, everybody, to Build a Business Worth Buying. I am really looking forward to this episode. We have my good friend Glenn Gooding on. Glenn is someone you should know if you don't know him. He's the president of iDrive Logistics, which is a strategic parcel and transportation analytics firm that works with some of the largest shippers in the country. He's my go-to guy anytime I need to know something about Parcel. He's the host of Parcel Perspectives, which is a small parcel 3PL specific podcast. And with decades of experience in supply chain optimization, including a long tenure at UPS, how many years was that?
21 years at UPS. Yes.
21 years. So he he knows the insides and the outside of UPS. He's worked with some of their largest shippers, and he's really just become this go-to expert when people are thinking about parcel. And what sets iDrive apart under Glenn's leadership is their unique ability to quantify savings opportunities. And they do this with both technology and with this deep domain expertise that they have. And they've been on the front lines of M&A activity, not only advising companies as they integrate different logistics operations, but also as companies are looking to position themselves for premium valuations. In this episode, we're really going to dig into the reality behind the economies of scale, how cultural missteps can sabotage even the best M&A logic, and what it takes to command a tech multiple in a service-heavy business. So Glenn, I'm really looking forward to this. Thank you so much for being on.
Thank you so much for having me. I've been looking forward to it as well. Thank you.
Of course. Well, I want to dig right in. And I think that everybody talks about leveraging volume to get better parcel rates. And this can be something that a lot of people will put into their deal logic to say, hey, we can save X percent if we just combine our volumes. What's the real ceiling that acquirers can expect when it comes to combining shipping volume?
That is a meaty question, Aaron. Let me attempt an answer this way for you, Aaron. Yes, I would say there's a minimum deal size to constitute certain levels. And so I would say once you get in the range of $10 to $15 million per year in transportation spend, if you were single sourcing and using that, you should, under the right circumstances, be able to fairly compete in the marketplace with larger players if done properly. So that may blow some holes through some folks that are sitting on $100 million transportation spend saying, wait a minute, wait, what's going on here? And so I'd like to maybe expand a little further. I've always held on to the tenet that, volume or amount of volume or spend level doesn't necessarily constitute discounts and aggressive pricing from the carriers. So many other factors go into that. One thing at iDrive that we've kind of marketed and touted was kind of a carrier cost modeling kind of approach. And what that is intended to mean is outside of doing benchmarking exercises or understanding what a good discount might be in the marketplace, is having a deeper understanding of how a shipper aligns with a specific carrier network, whether it be from pickup to consignee locations, the amount of touches, operations it's moving through, as well as modal distribution, weight distribution, zonal distribution. And so it's always been my opinion that if you have a deep understanding of what a good parcel is to a particular carrier or what those operational efficiencies might be, you're going to achieve a much better commercial alignment with the carrier, and one that is probably set to last a lot longer time period under a good, healthy partnership scenario versus a race to the bottom for the best discount.
That makes sense. So to kind of drill down a little bit more, if I am an acquirer or I'm thinking of selling my business and I'm trying to pencil in how I might be able to get those elusive synergies that everybody talks about, is it as simple as just saying that if I have a $15 million spend and they have a $20 million spend, that we should get double the savings because it's roughly the same? Or is there is there an efficient frontier where even if I had $1 billion worth of small parcel spend, there's a limit to how deep of a discount I could actually get?
Yeah, there's definitely a limit. I was recently working with a client and I was looking at the commercial rates and they very large spend, let's say in the range of 500 million, right? And they'd gone through an acquisition where they'd acquired a smaller company and wanted to bring it on. Um, I knew based off my background that the commercial rates that this particular client had with the primary carrier were at a loss. The carrier had positioned the volume at a loss. So if you're in that position or close to that position, um, why on earth would adding more volume to it dictate even greater discounts and greater loss? So I think it's a fairly naive approach to say there's financial arbitrage in taking 1 + 1 and make it 3, right? Sometimes 1 + 1 can be 1.5. Sometimes 1 + 1 can be 2. Sometimes 1 + 1 can be something greater. So there's other factors to consider in that equation. And I'm happy to go into some of the other factors I think need to be considered when looking at that. It's not as simple as saying 15 million plus a 30 million or a 30 plus a 30, therefore double our discount levels. That's not good calculus, in my opinion.
What are some of those other factors that people need to think about?
Well, for one, what is the overarching strategy of that acquisition? So, for example, do you have redundant facilities in similar geographies? Are you planning to bring those together? Is there a plan there for that? Are you going to improve pickup density for a carrier? Therefore, make the packages a little more efficient in that network. That could be one consideration. Another would be, who are these two companies currently sourcing with? If one is sourcing with carrier A and the other one is sourcing with carrier B, then there may be some real validity in saying, wow, if we're able to double this and move everything to carrier A or move everything to carrier B, that there might be something in it for both parties, right? To do something on that front, given macroeconomic conditions and a carrier's hunger for average daily volume, which is very hungry right now. That's an option. If you're both sourced with carrier A, then carrier A at the decision maker level, what I used to do, would come back and say, well, why? I'm just looking to dilute revenue, Or if you're a company that is inherently producing products that fit a weight profile of 1 to 5 pounds e-commerce, and suddenly you want to diversify your product stream and you acquire a bike manufacturer. That's a much different parcel characteristic. So should that drive additional discounts? Maybe. But what would those additional discounts look like, right?
Yeah.
What does that work? There's other hidden factors as well. It's those dreaded terms and conditions in the carrier agreements, right? And I'm not talking about things like understanding accessorial spend and surcharges. At this point, with analytics where they are, everyone should have a handle on those things. But I'm talking about early termination clauses. I'm talking about, primary carrier status that both carriers like to impose, sometimes specific percentages, right? It could be rebate structures. There could be a whole variety of other things you need to consider, and there could be a deeper narrative as to how both companies got to where they are, right? So if we go through an example where one of those companies just went through a very contentious negotiation with the carriers and finally got across the finish line to clean up EBITDA for an acquisition with carrier A, and the acquiring company buys them now at this improved EBITDA and says, wow, we want to incorporate it here. They may be running into a brick wall based off of all the things that just transpired to get to a finished deal there. And then to suddenly say, we want more, right? So there's so many other factors to consider in that. It's just not simple math saying 30 million plus 30 million should constitute twice the discount structure I get today. I think anybody that looks at that realizes you're going to hit a finite bottom somewhere.
Yeah, I remember when I was at Mirror and Mirror was acquired by Lululemon. I had to sign, I think, like 2 NDAs to see what the FedEx rates were, and they were aggressive. and they were kind of like amazing that we had them that way. And so I think that to some extent, I don't know who goes and does that level of detail that you're laying out. They should, but I don't know who does it. But it seems like it's much easier if you have a massive spend and you know what the rates are going to be. You're just going to move somebody over to your existing rates. That seems to be a much easier way to get an
It
assumption
does.
for what the savings could be. But it seems like most acquirers dramatically overestimate their ability to generate savings post deal.
Yeah. Well, you're exactly right. And so if you're massive, you have a massive spend, and you just run an analysis to say, if the acquired company were to move to our procured transportation rates, what is the benefit? What's the arbitrage? That is one way of looking, but it's oftentimes not that simple. I just went through an exercise where a very large 3PL acquired a smaller 3PL, still large in its own right, and assumptively thought, well, I'm going to take that existing portfolio and move it over this greater discount structure. Big challenge. It's resulting in that could result in a 30% revenue dilution on the existing business that would be moving underneath this. And so the incumbent carrier is going to ask some hard questions. Why? Why would I do this? Why is this good for me? I have it on both sides. What controls are in place? What governance assurances can you provide? If I were to do this, what assurances can you provide that I'm going to retain all this business or I'm going to grow that piece, right? So I think there's other organizational pieces you have to get in order before you think assumptively that something like that can just happen, right? And I can tell you that ultimately on that project they may end up getting there, but there's going to be some other real hooks attached to it, right? Punitive language and very aggressive rebate tiers that require all the business to move that direction. So there's other gotchas in the mix, Aaron.
Yeah, it's this interesting piece because obviously, whatever you're spending is whatever your cost is their revenue, and so there's this perpetual Titanic battle that's always going on. What
100%.
are some of these big gaps that you see between the expectations that an acquirer has versus the reality?
Um, well, the first big gap we just blew up pretty well, and that is that volume dictates greater discounts all the time. Growing that. Um, the other, I would say, another substantial gap is understanding what's happening in the space right now as well. So there could be points of leverage. Um, let's talk about fuel surcharge for a minute and what's happened since COVID. Since if we go back 3.5, 4 years, the primary carriers, we know who they are, right? In the duopoly environment, have effectively manipulated their fuel surcharge tables upwards of 14 times. So in a static fuel environment, what fuel was trading at 4 years ago, if it were still trading now, what was an 8% fuel surcharge would now be an 18% fuel surcharge. It's crazy. It's crazy. So you've always got to have your eye on the ball. If an acquirer thinks that everything that's written in that contract are the ultimate boundaries or the confines of what's going to happen with their spend, then they're sorely mistaken, because the tariff will adjust multiple times with or without notice, zonal adjustments, redefinitions of what's additional handling, fuel, payment surcharges, you name it. It just goes on and on and on and on. And it just seems it's ironic that in a kind of a static small parcel market, that the two primary carriers outside of the USPS that duke it out are kind of duking it out over a finite piece of the market that's kind of shrinking over time with other innovators in the space. And their answer to their revenue shortfalls is, let's make it more complex, let's make it more expensive, let's do other things. Yeah. So it's interesting to me, and I'm not sure where it's going to settle out, but we're in very interesting times. If I didn't adequately answer your question, hold me into account, Aaron.
No, that was good. I mean, I think there's definitely like a confuse and divide tactic that's out there in order to try to these are businesses too. They need to figure out how they're going to correct, and they need to figure out how they're going to get revenue for their shareholders. And when
100%.
the overall volume is lower and things are more expensive, like a massive Teamsters contract, like you got to find ways to pay for those sorts of things.
You do. You do. And that opens the door to other, I think, important topics. Is in today's market, I know that one point single source versus multi-sourcing. That's an interesting topic as well, right? Where's the benefit? Where's the crossover? What makes sense in the space? And in my opinion, in today's world now, in a perfect world where you're operating with trust and credibility with the carriers, you have to align and come to the realization not all parcels are perfect in one carrier.
Hmm.
I would never advocate for 100% usage of USPS, 100% usage of UPS or FedEx, 100% usage of Amazon delivery or Uni or Viho or any other solution. Or OnTrack or you name it. Every carrier has its particular areas of focus that it really covets and desires, and I think it requires.
Yeah, so let's kind of dig into that. So I want you to act as if you are advising an acquirer, right? And you're trying to take a look at a potential deal. I guess the first question is if you see a brand that is that level of optimized and they've got 4 or 5 different carriers versus somebody who is single sourced, is that a good thing or a bad thing? Because on the one hand, if they've optimized, it may indicate that they've thought about these things. They've really, maybe the rest of their operation is in a good spot. Whereas if it's single source, it's like, well, we know that there's meat on the bone here.
Yeah, I think barring the exception that there's a very finite, limited range of variation in the parcel characteristics, single sourcing would tell me that there's probably some opportunity there. The thing that has to be uncoupled and navigated is what is the current status of the relationship with the carrier, and what expectations are there, and what are the gotchas? What are the performance requirements? What are the revenue commitments? What are the potential risks of an early termination or going to bid early, barring this? There's other bogeys to navigate there, but if you're an acquirer that has multiple, I guess the first thing I would look at is say, in a nutshell, 4 or 5 carriers in a shipper's environment. Is that necessary? I would contend probably not completely necessary. I think that's maybe getting to the range of a little too complex, contingent on what you're trying to do. But three carriers, maybe 4 in the max, might be something where you have some operational redundancies and contingencies in the event that there were a Teamster strike and someplace to fall back to. But that would tell me that you're probably given a lot of thought to sourcing the right kind of volume to each carrier that they like and do. And then if I were looking at a single sourced acquired company, now it's really deconstructing that existing partnership and determining, is there risk associated with deconstructing it? Can we take that to market now? Can we fold that in under the existing 3 carriers that we have on that front? It involves a tremendous amount of intellectual capital and a whole lot of analytics to understand that piece, right? I think the analytics are probably in the hands of a good analytic person with the right tools. That's the easier piece. The more difficult is now having the expertise to understand what is the data telling you, and what are the bogeys, what are the potential minefields that I could be stepping in that process.
Yeah. Does your answer change if the acquired company was just sourcing from a 3PL and had exposure to lots of different parcel carriers? But
It does.
have
Changes a lot. Changes a lot. A big part of it too is if the acquired company, if the strategic mindset is they want to bring them back in-house and bring those SKUs in and do it the way the acquiring company is doing things, that would warrant one answer. If they want to stay in a 3PL environment, that might yield another answer. But there would be a lot less risk in my mind of that situation outside of whatever service agreement you might have with that particular 3PL and what it takes. Do you have to honor 2 more years of a service agreement with the 3PL, or based on being acquired, or is there an easy way out if you needed to? But yes, the answer would be different.
Okay. Are there any other aspects of say the shipping P&L that someone who's doing due diligence really needs to take a look at, or is it really just total spend?
Hmm. So we're in an environment now where a parcel that might be qualify as Zone 2 in UPS network may not be Zone 2 in a FedEx environment, may not be Zone 2 in a USPS environment. So it's contingent on how deeply you want to unpeel the layers of the onion on this piece and understand that thing. But, UPS has been making a lot of zonal adjustments as of late. I expect that, as usual, the competitors will follow suit and adjust as well, but it's going to be a lag in the near term. There can be some real relevant differences contingent on where you're shipping from and what you're shipping to. From a P&L perspective, I think the other piece that I mentioned earlier is you really want to have a clear idea and sight on what kind of early termination language is in place and what's going on. And so one red flag that pops up to me when I start diving into a particular client, if I see early termination language that is particularly punitive, like I'm not talking about 2% of the previous 52 weeks, but something much higher,
Mm.
that tells me something dictated that. The carrier that imposed that felt as though they needed to do that based off of something that company did in a negotiation or in their sourcing going on. And when I see those types of things, that tells me that there could be more risk in the equation. It is
Potentially
not
you were
unheard.
acting in bad faith or something in a negotiation previously, and so they're less
Potentially,
trustworthy.
yes.
Okay.
Lack of trust. You said one thing, you did another, right? And in those situations, I have seen uh, in environments like this that aren't considered in the P&L is suddenly the carrier feels like they're being dealt dirty, and they'll issue a notification, a 30-day notification. You're on published rates next month.
Oof.
Now it's a mad scramble. Now you're in trouble.
Yeah.
Massive impact to P&L.
Wow. Have you seen this derail or blow up any deals that people have been looking at, or is this something that kind of the company has made its bed and now they have to lie in it?
It's more of a clawback, and the company's made its bed, and now they have to lie in it. I haven't seen it kill deals because normally, from my seat, I want to avoid the gun jumping clause,
Mhm.
right? So I'm normally dealing with this post acquisition, not pre acquisition, and so I see it. I see it just really tanking the P&L on an acquisition or impacting things on that front.
It's almost like an unintentional poison pill in that case.
Yes.
That's interesting. One of the things that's unique about iDrive is, we've talked a lot about small parcel and
Mhm.
optimization, things like that. And you guys do an excellent job there. You also operate a network of fulfillment centers. Can you just talk a little bit about that? And I've got some follow-up questions about how you guys are buying and merging and doing those sorts of things.
Certainly. Thank you for the question. So if you think of iDrive, the center, our core DNA is around being an extreme expert in the small parcel market. And that's what's facilitated us being advisors in the space. If you apply that to the 3PL space, what we've done is we've invested heavily in building out our own proprietary transportation management system. It's currently branded as ShipCaddy, and that operates as the technological backbone, for printing labels and rate shopping and things in our existing 3PL environment. What we found is through that, we have direct relationships with many carriers now, where on the TMS alone, we can now offer a 3PL a true multi-carrier solution, one that aligns with your parcel characteristics, whether it be extremely lightweight, midweight, heavyweight, commercial, residential, you name it. And so a growth area we have now is identifying 3PL operators that don't have that type of capability. They're a one-stop shop. And now to integrate with ShipCaddy, our TMS platform, and get access effectively within a week or two of a true, robust multi-carrier solution that offers them many more solutions to go out and more effectively compete in their space and their geography, and offer more competitive pricing on the transportation piece.
And so, are you guys just selling the TMS, or are you buying and taking stakes in companies as well?
We are just selling the TMS at this point.
Gotcha. Okay.
Selling the TMS and helping those 3PLs acquire brands, retain them, and offer best-in-class transportation solutions.
Cool. So obviously these 3PLs, many of them are looking to grow, to be acquired, to buy and sell. I know that you've been a part. You talked about one deal that you mentioned of one 3PL buying another 3PL. I'm
Mhm.
curious your perspective on what is the harder thing to integrate. Is it the data? Is it the systems or the people?
That's a great question. It's an easy answer for me. It's the people.
That's the harder piece. Okay.
I really think it is. The data and the systems, those aren't necessarily easy, but those are finite, right? They're finite. It's a function of investment. It's a function of time. It's a function of prioritizing a roadmap for technology to get to that point. Invariably, the challenge is the people. The people, they're all sentient folks. They all have their own self-interest. They have their own concerns. They have their own fiefdoms, their own kingdoms. And invariably, that is the hardest part. You know, Great example of the one I was talking about there, one acquiring the other. And for some reason, I think it may have something to do with um, payout and clawback time period and things like that. But both entities are kind of allowed to operate autonomously with dual CEOs, dual C-suite, no combined SG&A, no combined governance, no combined network as such. But simultaneously, they want to achieve the benefit of the financial arbitrage of moving all spend volume over to this carrier under one agreement, right? And
Of
that's a
course.
tough one. That's an unrealistic alignment at this point. It sends very inconsistent messages into the marketplace. It dilutes brand credibility in the space. It yields some of those very, very punitive, early termination penalties and things like that I talked about.
Hmm.
And and frankly, it's very disruptive and confusing and frustrating to both executive teams because they both have their own individual interests, their own individual P&Ls. And now both sides feel like they're being held hostage by what they would call the antics of a carrier A or carrier B who is entirely confused about what the heck is going on in this space.
Yeah. Who's in charge here?
Yes. Yes.
Yeah, that makes total sense.
Yeah.
Um, there has been a lot of M&A divestitures, things that have happened in the small parcel world in recent memory. I mean, you've got Pitney Bowes selling off their fulfillment network. You've got UPS buying a bunch of stuff and now starting to spin them out. I think Where to Go was just announced recently. What is your perspective on what is going on in this market?
Wow. Um, I've never seen uh, anybody who knows me, first of all, has heard me say that every subsequent year is more complex and more expensive than the previous year, and that's held true. However, 2025 is crazy. It's crazy. Um, I think the USPS does a lot to set the residential market, and so the Delivering for America agenda, as championed by the former Postmaster General Louis DeJoy, is doing a lot of things to try to make the USPS more profitable or move them to a profitable status. Um, he, in 2025, really began pulling some levers. He really attacked the parcel aggregators, the postal aggregators, eliminating
The
DDU
mail
induction.
innovations, the DHLs, those guys.
Correct. Correct. and trying to move that volume to ground advantage, a traditional USPS movement. And so what I've seen is when you look from a total calendar year from a January to January perspective, if you're a 12-ounce small parcel shipper shipping Parcel Select inducting to the DDU, you're no longer allowed to induct to the DDU. It's now to the D hub, and you're taking effectively an 83% increase when looking over that 12-month time period. That is very disruptive in the small parcel space. So now you have Pitney Bowes doing what they did. You have UPS MI, who is struggling mightily. I'd be surprised to see them survive this year. You have DHL e-commerce, who is scrambling and changed their tone. Anybody who is working with DHL e-commerce knows now their area of focus is 1 to 9 pounds. It's not less than a pound. Right. So you have all that happening. And no surprise, UPS and FedEx don't covet 1 pound parcels in their network or less than a pound parcels in their network. It doesn't align well with them. So you've got all of that disruption. You have de minimis being halted. You have a whack-a-mole version of tariff war going on, right? We just got, a new delay on the EU 50% tariffs, now that is buoying the market temporarily as people are trying to figure out what's going on. So you have all that happening, and now you have the opportunity for other folks to innovate. So now there's other companies that are bringing in great tech that are able to pick up and lightweight packages make sense to them because they're handing it over to folks in personal delivery vehicles. And so if you're paying a fixed expense per parcel being delivered, and you can fit 100 parcels in a Honda Accord instead of 25 larger ones, that's better for you. So you like the lightweight. So it's creating opportunities in the space. All at the same time, you've got the legacy incumbents, UPS and FedEx, that want to hold on to an entire portfolio, right? And want to hold shippers accountable. And then you have Amazon, who's making very strong forays into direct contracted, delivery services outside of a Fulfillment by Amazon or the Prime channel, really just going after brands directly on that front. So it is a crazy, crazy market. I feel like we have the market right now is a bottle of vinaigrette salad dressing. It's been shaken. And now we're sitting staring at it, waiting for everything to stratify again and see where we settle, if that's a fair analogy.
No, that's a good one. And, my question is really, if you're a parcel company, right? Let's put ourselves in the shoes of a parcel startup or a company that may want to exit at some point down the road. How do you know what is going to be valuable to an acquirer today, or 3 years from now? Because it sounds like, even just taking the USPS changes with postal induction, there were whole business models that were upended. And so as you're going through and you're building out things, thinking that the world is going to be one way, and you find out it's very different, how do you actually go about building something that is going to be enduring? Or are you just kind of, to use your analogy, are you basically just going to be chasing and waiting to survive until things try to fight, and then which area you can play in?
Your best bet right now as an emerging brand like that is one of two things. One is you can lean into a great technology solution, something like a ShipCaddy or some multi-carrier TMS platform that offers platform rates available to you that you qualify for, right? You have to have volumes to qualify for some of these shippers. Let's make no illusion about it. You can't ship 2 packages a day and expect Amazon delivery to come pick you up. It's not going to happen, right? That's one option. The other is find a good 3PL operator, right? I know you know something about that, right? With the companies you have and host, is align what your vision for your brand, for your product is, and find a 3PL that aligns with that vertical that offers value to you on the kitting side or the customization side, whatever helps differentiate you, and gives you access to a suite of carrier solutions, right? And allow their expertise and their scale to mitigate your cost of goods shipped in that
It almost
equation.
sounds like in a period of volatility, there's going to be a flight to bigger groups, or looking for stability in some sense. And so, is that a fair assessment? Do you see that people who maybe try to do things on their own are going to say, "Hey, I don't really know what's going on here. I'd rather tie myself to a much bigger ship, maybe not get as good of a rate as it's going to, but at least I know it'll be stable." And there are people who have more time than I do to figure things out.
I do see a lot of that. I do see a lot of that. The other fallback is I see a lot of companies taking the easy way out and say, ShipStation has a great platform rate with the USPS and with UPS, and I'm just gonna ride that wave. And what happens, what happens. Now, the bad thing about that is those are dynamic pricing models, and you don't really have control of your destiny there. If you go to someone larger and more sophisticated, then you can rely on their expertise to, you know, a good 3PL operator, and there's many that are out there. A good 3PL operator should be able to insulate a brand from a lot of this noise. And if you're just aligning to a desired CX and you're carrier agnostic and you allow the 3PL to do that for you and provide the right type of CX, I think that's the best way to scale and grow and kind of endure a lot of this noise right now.
That makes a lot of sense. Um, you know, you. I think what's interesting about your career and just knowing you for a lot of years now is you've got very, very large big company experience, but then you've also gotten deep into the nitty gritty of building things yourself, working with people who are um, who want to punch above their weight. Um, I guess if we put small parcel aside and we kind of go a little bit more meta, what are some of those attributes or characteristics that you find the best companies are building or working on that lead them to actually increase their enterprise value?
Are you referring to a moat in this particular situation, or are you just talking about differentiation and just increasing
Just
value?
differentiation. I mean, I think that you know a lot of people have had an idea, they work on it, they put some effort, put some money behind it. They realize that the idea wasn't as good as it thought it was going to be, and so then they're pivoting and finding things out. And I'm trying to get a sense of how did UPS get a perspective of what, this was a company worth betting on because we think they're going to grow, or this was a company it was worth buying because we think we can grow it. What do you have anything there you can share?
For sure. If we, I think some of the companies that have the most attractive offering from an acquisition perspective, if they're doing something special on the client acquisition component, if they're particularly efficient on that matter, if they've really figured out how to, I'm speaking anecdotally and probably oversimplified, the social influencer space or the social marketing space to quickly acquire clients and then retain them, right? Um, the retention strategy, I think, uh, does a tremendous amount of valuation. I'm sure you do that. So if you have a very sophisticated or bespoke type of, um, let's say, subscription, not a one size fits all type of, mystery tackle box type of thing, but something that's very bespoke, specific to that person's likes, dislikes, sizes, school they attend, you name it, that can do that very efficiently in a customized way. Those are exciting type of brands and opportunities that I see on that front, right? I've had the benefit of seeing some companies that are very brilliant in aspects of those that I think would command the greatest multiple and make themselves a real acquisition target.
That's helpful. And so as you think about the efforts that you've been putting into iDrive and all the different bets on ShipCaddy or the fulfillment network or just the optimization piece, how are you guys thinking about and I don't know if there's an intention of exiting one day, but we always say that businesses aren't sold, they're bought. And so part of this is just building something that has value, that is doing well, that you could run in perpetuity, that someone else may find interest in at some point, as opposed to dressing up and saying, hey, we're for sale, here's our stuff. And so I guess taking what you've talked about, how do you think about the work and the efforts in either the things that you're doing or not doing at iDrive that you think will be setting yourselves up for a potential exit down the road if that's something you choose to do?
You bet. Well, the area that I think we've always been exceptional at would be the intellectual capital piece, the professional services side. Unfortunately, that doesn't drive the greatest valuation, right? It's hard to scale Glenn Gooding, right? And I
You're a
don't
big
mean
guy.
that.
I mean,
Well, yeah, but I don't mean that, in any sort of a braggadocious way.
yeah, it's hard to clone people.
It's a harsh reality. So that said, there has to be a vision for providing value via technology, scalable technology. ShipCaddy for us is that scalable technology that we're trying to offer into the space or into a vertical. That said, I don't care how sexy or capable your technology is. If you don't have a foundation of strong professional services, then I think it's a house built on a foundation of sand, in my opinion. So I think from my seat, the optimal valuation is the right type of balance between a professional services foundation that complements, steers, guides the technology along with customer feedback to stay as innovative and value added as possible, but doesn't allow the technology, particularly in the transportation space where you can get in a lot of trouble, to run off and get yourself in a position where, whoops, we just upset the carrier and now we're on published rates in 30 days, or we hadn't considered the early termination clause, or a variety of other factors. So I think it's got to be a blend of the two, and that's what we've really worked hard at iDrive, and learned a lot of valuable lessons along the way. So will we ever stop offering professional services? No, I hope not. I enjoy it. It's something that I feel I'm pretty good at, but I have to be realistic, and I have to realize, how do I do that more effectively across a broader set of clients and offer value in this space? It has to be done via technology and through those offerings. One of the ways I found it to be most efficient in what I do is this TMS platform, multi-carrier platform rates in a 3PL environment, to enable shippers to win and grow and be competitive in this space and get access to services that they couldn't on their own, and navigate all this noise in this very disruptive small parcel market. That's been our vision at iDrive.
When you talked about this balance between professional services and tech, is that a balance based off of like revenue or headcount? You know, it's kind of a catch-22 because the tech side is going to give you the highest valuation, and so in theory you want to grow that. But how do you, I guess, avoid losing your moorings or your footing if you are leaning into the tech 100%?
Yeah. That's where I think a lot of lessons have been learned. It's a tricky one. It's a tricky balance, right? And it's one that you can get yourself out of balance very, very quickly. Having been the benefit of kind of going through this for a few years now, my personal opinion on that is, I don't think you can ever lose sight of who you are as a company, what your DNA is, what differentiates you in the marketplace. And that being said, you may not want to strategically grow, for example, professional services, but you don't want to lose sight of a focus of, that's the foundation of the house. That's what pays the bills. That's what elevates the brand, right? That's what drives innovation through the technology. So ultimately, I want the technology to grossly outperform professional services from a financial perspective. Who wouldn't, right? The tech drives the higher multiple. But I think it has to be done methodically and without losing sight of what and who you are as a company, if that makes sense.
It
Continue
does.
with the thought leadership. Uh, continue with driving results and benefits, even in the very large shipper arena on these things. And ultimately, those exercises lead you down paths where you can drive greater innovation and opportunity through technology, in my opinion, and scale.
Yeah. As you've talked to other folks in the ecosystem, potential acquirers, other providers, things like that, is the answer here to be building tech-enabled professional services, which is more doing what you're doing, or is it to build something that's completely different that leverages that knowledge set that the professional services build?
It's more more the latter than the former. I know there's a lot of activity in the space around tech-enabled type of solutions to displace professional services. I think there's some benefit to that, but I've always kind of equated it to handing a handgun to a toddler. You got to be careful, right? Yes, it's an effective tool, but it can be very, very dangerous if in the wrong hands or in inexperienced hands. So I love good, robust analytics, predictive analytics. Those are great, but it has to be balanced with some intellectual capital as well on that front. So I have a tendency to lean more towards the latter that you'd mentioned versus the former.
Makes sense. Well, Glenn, I know we're coming up on time here. This has been a fun conversation. We've got two questions that we always ask folks on Build a Business Worth Buying. And the first one is, what is the best example of a moat you've seen a business build?
Yeah, that's a great question. The obvious moats are, like Apple with their ecosystem of product and how hard it is to decouple yourself when you get in. I'd like to tell you what my vision of a good moat is in the 3PL vertical. So many 3PLs I find fall prey to a race to the bottom. I've got a good transportation discount here. Please, please, please. And that ultimately leads you to a sourcing relationship with the carriers that becomes contentious, lack of trust. As a result, what happens is a lot of punitive language in contracts. A lot of things happen on that front. I think the proper way for a 3PL to build a moat is determine what value as a 3PL can you inherently provide to the marketplace. When I say the marketplace, is there value you can provide the carrier? And is there value you can provide the brand outside of a robust transportation rate? The greatest example I provide on that is imagine a 3PL that has 4 different nodes, 4 different distribution centers nationwide. I cringe when I look at a shipping profile and I see the average zone is 5. Okay. That tells me immediately that there is no value that 3PL is providing either their brand or the carrier in that environment. It's the carrier looks at it and goes, well, why am I doing this? All I'm doing is enabling this 3PL to go out and cannibalize existing business. They're not bringing any value. But with those 4, if you were sophisticated enough and offered a solution to put the fastest moving SKUs closest to the customer demographic, and you came to a carrier and say, hey, look, I want to collaborate with you. I know not all packages are equal in your network. I want to give you what it is you covet, and I want to do it as efficiently as possible. I want to provide you great demand forecasting. I want to plan with you over peak season. I want to mitigate the strain on your network, and I want to reduce the number of handles in your network from pickup to delivery. And I think I can give you volume that's not a zone 5, but a zone 3 on average, right? That's going to resonate with the carriers. Simultaneously, you're giving something to the brands as well. You're giving them and saying, you don't have to spend a premium expedited service on 15% of your volume because we aren't closer. We can get you the most economical transportation solution right? And still achieve a 1 or 2 day delivery time in transit footprint, something you couldn't have done on your own. That's a great example of what I think a great moat is in the 3PL space.
Yeah, that's interesting. I haven't really heard of anybody talking about providing value to the carriers, but you're absolutely right. I think most people just treat them as a necessary evil, right? And you're going to go chasing a penny here or a penny there. But I think this,
And the challenge is you create a self-fulfilling prophecy.
yeah,
You end up being treated exactly the way you're treating them.
it's true. It's true. Good answer. The second question: if you had to start today, how would you go about building a business worth buying?
Um, well, I've been in the supply chain space now for 39 years, so it'd be fairly foolhardy for me to venture outside of that space. What I would want to do is I'd want to look and find, with the total available market, the TAM and the small parcel supply chain space, what is an area that I think is the greatest underserved area? What is missing and why? And then I'd want to build out a technology that helped enable that, right? And align with that value. Now, what exactly that is would be the $64 million question, right? But I'd want to find an area, a service, a niche, a vertical, something with a decent total available market that I felt there was a miss in the marketplace. It's underserved in some way. And I could find a way to connect some dots and provide some value in that space to disrupt the space. I think innovating and disrupting in that space is the way to go. I'm not a big fan of disrupt the marketplace with lowest price and then elevate the temperature over time, unless you're building up a good moat, other value.
Yeah, otherwise you have someone else who's just chipping away at that cost advantage as you're trying to raise it.
Yeah.
Well, Glenn, this was a lot of fun. Thank you again for coming on. If people would like to get in contact with you, what's the right way to do it?
The best way would be Glenn at iDrive Logistics is a great way. You can get me on LinkedIn. Please subscribe to my podcast. There's a lot of ways to get a hold of me in today's world. So those would be the best. Thank you. And by the way, I want to say it again. Thank you again for the time. I've really enjoyed the conversation, and I really appreciate our relationship.
Same here. And thank you guys for listening in and tuning into this episode of Build a Business Worth Buying. You heard Glenn. If you like the episode, please like and subscribe, and feel free to check him out on Parcel Perspectives. Until next time, we'll talk to you later. Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.